Good morning. Let's get started with our next session. Thanks for being here. I just want to, before I hand it over to the first set of authors, remind everybody that the conference is live streamed. So don't say anything too crazy, I guess. The first paper this morning is titled Robust Fiscal Stabilization by Alan Auerbach and Danny Yegan, and I think Danny's going to start.
All right, thank you. Thank you to the organizers for including us. The Congressional Budget Office projects that America's current law fiscal path is unsustainable, but any fiscal path is sustainable if Congress in the future reacts sufficiently strongly to rising deficits. And our paper asks, how has Congress responded in the past to deficits? And how strongly does Congress need to respond to deficits going forward? To study this question, we take advantage for Congress's behavior to date of 40 years of CBO data, usually twice per year, once in the winter and once in the summer. CBO publishes an update to their deficit projection. CBO divides its updates into those stemming from new legislation and separates them, as in the screenshot, from other updates due to economic or new program information. We use these data to ask whether Congress legislates deficit reduction when the projected deficit rises. We follow Allen's 2003 Brookings paper in constructing about 80 half-year period observations since 1984 with three key variables. The first, Congress's legislated change this period to the average primary deficit over the coming 5 years, as shown in this screenshot. Second, CBO's projected deficit over those 5 years using CBO's projection from the prior period. And then third, as a control for the state of the economy and countercyclical fiscal policy, the lagged output gap based on CBO's potential GDP series. And all variables are scaled by the potential GDP. This graph reproduces Allen's key result from 2003, which, new to this paper, we show non-parametrically. The graph plots Congress's legislated deficit reduction on the y-axis versus CBO's lagged projected deficit on the x-axis. The graph controls in the background for the output gap, so everything we show you is net of the state of the economy. Suffixes A and B on the year data points you see indicate the first period of the fiscal year or the second period of the fiscal year. And the graph shows that over the first 20 years of the available CBO data, Congress, on average, cut the deficit when the projected deficit was high. So Congress acted in a debt stabilizing manner. And if you look at the upper right, you can see a 1991 data point. That's President George W. Bush, famously breaking the no new taxes pledge at a time of high deficits. And if you look in the bottom left, you'll see a 2001 data point, which represents, in a time of surpluses, the first Bush tax cut. The relationship is quite linear, with a slope of 0.15 and a t-statistic of 5. Just over half of the deficit response comes on the spending side, with the balance coming on the revenue side. And it's really the projected deficit that seems to matter, not the lagged debt to GDP ratio or the projected debt to GDP ratio. Okay, so that was then, 1984 to 2003. How about since then? This graph replicates the prior graph, but for the 2004 to 2024 era. And what you see is a flat line. On average, Congress legislated slight deficit increases, and the magnitude of those increases did not vary with the projected deficit. This graph omits the extremely unusual 2020 data point covering the beginning of the COVID-19 pandemic. When we include that, the slope actually goes more negative. And we don't want to overstate the precision of the zero result. We have 40 data points, but we are able to statistically reject the 0.15 slope from the earlier era. And with thanks to Heidi Williams, you can actually see this vivid change in congressional behavior when you put both eras on the same graph. So given this vivid change in congressional behavior, we wanted to ask, okay, how strong does fiscal feedback need to be? We first study gradual year-to-year fiscal feedback as in the earlier era. And then we also take Congress's recent behavior seriously. What kind of wait-and-see strategy would work where Congress waits to take action until if and when it's actually necessary to take action? To finish laying the groundwork, the empirical groundwork, we account for two risks: transitory shocks to the primary deficit and persistent interest rate shocks. So first, recent experience from the Great Recession and the pandemic suggest that one can think of there being transitory shocks to the primary deficit that yield discrete jumps in the debt to GDP ratio of about a magnitude of 25% of GDP, with no analogous sudden jumps in the opposite direction. We assume a Poisson process with an average of 2 such deficit disasters in a century. We assume only 2 because the Great Depression actually didn't yield that much of an increase in the debt to GDP ratio when scaling by the potential GDP, and World War II is less of a clean data point. The second risk we account for is persistent interest rate shocks, as in Doug Elmendorf's and Neil Mehrotra's work as well. As I suggest in a parallel paper, the debt ratio builds on itself at a familiar R minus G rate that can be termed the excess interest rate, the nominal interest rate R, in excess of the nominal GDP growth rate G divided by 1 plus G. This graph plots the excess interest rate over different rolling time periods since America's founding. The mean is negative with substantially large swings and some clear persistence. With thanks to our discussant Valerie Ramey, we use the annual data since the abandonment of the gold standard in 1971 to find an AR1 coefficient of just under 0.6 with substantial residual variance. Okay, with that, let me hand it over to Alan to integrate these facts into a model.
All right, so we to answer the question, or try to answer the question that Danny posed, which is how much feedback do we need in the current environment? Obviously, we have none right now, but what would we need? So to address this question, we put together a simple model of the evolution of the debt. The first equation here is just the, except for the error term at the end, is just the standard identity relating debt to its lagged value. Rho here is the R minus G term because we're looking at not the level of debt, but the debt to GDP ratio. S is the primary surplus. ES, that is a shock. These are those asymmetric Poisson shocks that Danny referred to in showing you the recent evolution of the debt. We just assume that these shocks are shocks to the debt. And in particular, we assume that they are not shocks that at least the kind of feedback such as I estimated responds to, in part because when I estimated it, I found that it was projected surpluses or deficits that mattered, not any recent changes in the level of debt, even if that's what you might think should affect legislation. The second is the AR1. The second equation is the AR1 process that Danny mentioned, and the EUs are the shocks to the those residual shocks to the interest rate term. And then we have the two gradual feedback approaches. The one that I estimated, which this is slightly modified from the actual version because it's based on the current deficit, which is what's in brackets on the right-hand side, but it's not that different in our model because we're assuming a constant underlying primary surplus. And then the final equation is equation that one has conceived in the literature. For example, in the work of frequently cited paper by Henning Bohn, estimating how the current budget surplus responds to the most recent value, most recent debt to GDP ratio with a coefficient D. So this table goes through all the parameters that we use, but let me focus on the three at the bottom. The C, a coefficient of 0.3, that's twice the 0.15 we estimated for the 1984 to 2003 period because there are two actions within a year. And so instead of just one of 0.15, it's two of 0.15, or roughly 0.3. The second 0.05 for the feedback based on debt, that's just the estimate from Bohn's research. The T is when we say, well, suppose we think Congress is doing nothing, but actually they have a very carefully considered rule, which is that they're going to wait until things get really bad. Really bad is, we take to be what Jason Furman and Larry Summers suggested when real debt service breaches 2% of GDP. And we let T be and we say that when that happens, Congress adopts a 1.5% budget of GDP budget consolidation, which is historically large, and we thought that's sort of about the most one can hope for. And then T says how often they can do it. And because obviously if they could do it every year, then it's not really a wait and see approach. And so we said, well, once a generation or so, let's imagine that they do that. They can do that. This is the results of 1,000, median results for 1,000 simulations, the blue line. This is the debt to GDP ratio over time. We simulated for 100 years, and it's going up because I didn't mention, but we have interest rates being affected by the debt, which we based on the CBO projections, sort of relating interest rates to debt. And so just because of these primary deficits driving the debt up, which in turn drives interest rates up, you have a sort of a very negative process, which leads to these uncertainty, leads to these high, high increasing debt to GDP ratio. It's worse in the red dashed line when you have no feedback, but you add risk, and it's primarily because of these asymmetric debt shocks, because they only go one way. The interest rate risk itself, you might think because of nonlinearity that it could also increase the median, but it doesn't. It's really the asymmetric debt shocks. And then the other three lines show under the three different feedback policies. The green line, the deficit feedback that I estimated, the orange dash line, the feedback based on the debt GDP ratio, and then the purple dash dotted line being these sudden consolidations, which they starts out performing worse, but if you can do it every 30 years and you keep doing it and it's permanent, then things look good. I'm going to skip this is basically showing deficits corresponding to the median deficits corresponding, but they're basically consistent. The funky step function is basically the process of sudden consolidations. Basically, the median primary deficits go down in jumps. The surplus. This is the surplus that's going up because, on average, at least, or the median, Congress every 30 years or so is adopting one of these 1.5% of GDP consolidations, which you might think would lead to even better outcomes than we show there, which they don't, which is just an illustration that if you wait 30 years, a lot of bad things can happen. That just shows the excess interest rate term. I'm going to skip and go to the next thing, which is to say, so suppose we ask a question how strong does feedback have to be in order to have success? And I'm going to focus on the case of risk, because under certainty, it doesn't have to be very strong. And under the case of risk, which is in the red line in the bottom of the table, and we say, what is success? Success is 95% of the time, the terminal debt to GDP ratio after 100 years is under 250%. If we were writing this paper 10 years ago, we might have said 150%, but we're less ambitious than we used to be, given where we are. And the answer is, if you look at deficit-based feedback, you need about half of what I found we actually did in the 80s and 90s. Under debt feedback, the estimates from Bone's work are sufficient. Under sudden feedback, though, that 30 years isn't going to cut it. You need to be ready to do it every 11 years. Okay, I'm going to skip to the last table, given that I'm out of time, and ask, given where we are, what should we be doing relative to what CBO projects we'll be doing over the next 10 years? So this is a 10-year projection with no shocks. So it's just saying, suppose that we were following a decision rule, such as one of the ones we simulated, either based on deficits or based on debt. And over the next 10 years, we started with the CBO baseline. And now we said, instead of following the CBO baseline, suppose we were, which basically doesn't include policy changes, that's the nature of the CBO baseline. Suppose we put in policy changes consistent with either of these decision rules. So the CBO baseline here for the primary surplus and the debt are shown in blue, showing a 2.6% average primary deficit over the next 10 years, and with 122.4% debt to GDP ratio at the end of the period. Well, what this shows in red and green is that if you're following deficit feedback, which is sort of the deficit feedback strength, about half as strong as what I found historically for the 80s and 90s, but what we found is what we need for a 95% success rate. Then instead of having averaging deficits of 2.6% of primary deficits of 2.6% of GDP over the next 10 years, it would be 1.4%. So that's an average consolidation over the period of 1.2% of GDP a year. For the debt-based feedback, we find less of only about 0.5% of GDP. The intuition there is because the debt-based feedback is more adept at responding to these big budget shocks, it doesn't have to be as responsive in the short run. And so if we thought we were following such a policy, which historically we didn't in the 80s and 90s, we wouldn't need as much. But if we reverted to being reactive as we were in the 80s and 90s, but only half as much, even only half as much, it would involve substantial consolidation relative to what our projections, relative to what the CBO projections have. So I've run out of time. These are our conclusions, and we look forward to all of your comments.
Our first discussant is William Gale.
How do I make
this or use this?
The timer doesn't work for Brookings authors. All right. Thank you. I'd like to thank John and Jan for having me discuss this paper. I'd like to thank Alan and Danny for a very coherent presentation at what is essentially 5:30 in the morning for them. I'd also want to thank them for producing a great paper to be a discussant of. Sometimes you read a paper and you're not quite sure what angle to take. This paper has two sort of complete sets of results and then there's this gaping unanswered issue. And as the first discussion, I exercised the option to take the bait and talk about the unanswered issue. First, let me summarize the main results, although they were summarized nicely before. The first result is there was fiscal feedback to deficits in the output gap in what I'll call the first period. All of that stuff went away in the second period. The authors call all the feedback going away, they optimistically call that a wait and see strategy, which suggests that it is indeed a strategy, not just a measure of legislative dysfunction. And it reminds me that when observing Congress or policymakers generally, there's quite often two hypotheses, both of which are consistent with the data. One is that they have no idea what they're doing. The other is that they know exactly what they're doing. And we'll see which interpretation is right in the future. But I think our natural tendency is to think they're just messing up when there might actually be reasons for their behavior the last 20 years. The second set of results are these simulation results. The numbers I put up here aren't crucial. The basic idea is if we don't have any fiscal feedback the next 30 years, we are in a terrible, terrible situation. If we do have fiscal feedback on the order of what we had in the first period or close to that, the situation is mostly better. There are some bad outcomes, but generally the weight of the outcomes shift toward more positive outcomes. So the bad news is without fiscal feedback, we have a terrible situation. With fiscal feedback, we have pretty close to a manageable situation. And then the gaping question is, are we going to get fiscal feedback? That is, why did policymakers change their behavior, and are they going to change back? And before I turn to that, I'll talk about the model a little bit, but I also want to have a kind of a reality check of the numbers we're talking about. The last table Alan showed the deficit going from 2.6 to 1.4% of GDP over the next decade if they follow the deficit-driven feedback rule. Right? In dollar terms, that's $4.2 trillion. Now, Phil said yesterday, economists, or maybe Danny said at a different conference yesterday, economists like to think in real terms. The budget is done in nominal terms. The nominal number there is $4.2 trillion that would have to be cut over the next decade, which to me seems implausible. But debt-driven feedback would only require adjustments only of $1.75 trillion. Okay, so a little bit of background. You've all seen this graph before. Maybe there's an interpretation of it that's a little different in the context of this paper. You can see I've marked off the first period. You can see the rapid buildup of debt and then the pay down of debt toward the end of that period. And then you can see the last 20 years debt has just gone up basically because of the two shocks Alan identified and for other reasons. What is interesting is we're due, in a historical sense, for that debt to GDP ratio to come back down. That seems very unlikely. It seems like if it could be stabilized over the next 20, 30 years, that would be good. But the historical perspective is helpful for showing that if debt to GDP does not come down, it's not just an aberration with the earlier period that Alan studied in his earlier paper. It's an aberration relative to our whole history, right? Our whole history is debt builds up relatively rapidly for some reason, for different reasons in different episodes, and then it gets paid down fairly rapidly. When I say paid down, I don't mean literally paid down. Sometimes it's GDP growth that helps, sometimes it's low interest rates that helps, et cetera. But the ratio is cut in, a rule of thumb would be that the ratio is cut in half after about 15 years after it hits these peaks. And you can see that that's pretty consistent across history. Now, this graph hides a lot of stuff. The reasons that debt went up in different periods matter, and the way it came down in different periods are different. And the issue that we face right now is, as I'll talk about in a second, we've got these very persistent entitlement spending that's going to push the deficits. It's going to be constant headwinds, essentially, against fiscal sustainability. Whereas in the past, World War II, for example, there was the military buildup, and then it came down. Okay, so let me talk briefly about the model. The model is kind of a standard, I thought, thoughtful and clear extension of standard budget projection models. The authors add two things to it: the economic risk and the fiscal feedback. One thing to note at the outset, when I say a standard budget projection, there's no behavior in the model, right? There's no business cycle, there's no monetary policy, there's no dynamic feedback effects like Doug talked about yesterday. It's basically an adding machine. It's a very sophisticated adding machine, and there's plenty going on in the model to discuss. So it's not a criticism, it's just a comment. But when at a high level, when you add shocks and fiscal feedback, two things happen. When you add the shocks, it turns out that they're non-symmetric. That means that the non-stochastic projection is not a central tendency of budget outcomes. In the tradition of discussing CBO without criticizing CBO, I will say when CBO does its sensitivity analysis, it does it in a symmetric way. So inflation goes up by 1 point, it goes down by 1 point, and interest rates go up by 1 point, down point. That kind of implies that the non-stochastic numbers are central tendencies, but this paper argues that they aren't, and that's an important contribution. The other interesting conceptual thing I think that mattered is the paper shows that R minus G is not that important. And we're not used to thinking that way because we're used to thinking in standard budget models where if R is greater than G, you get this debt deficit spiral and things are really bad, and thank goodness R is lower than G. But when you have fiscal feedback, R greater than G just raises the deficit, and Congress responds by cutting the surplus. So different things matter in a stochastic environment than typically matter in a non-stochastic environment. All right, having said that, I'm going to take the model at face value. I know Valerie's going to go into more details. I'm going to take the model at face value and look at this question about why did policymaker behavior change? And I just want to emphasize, this is not a political science sideshow. This is the whole enchilada here as we're looking forward. I also want to say that I don't know the answer. I'm going to give you lots of potential reasons, but if you come away from this feeling like I answered this question, I have misspoken. Okay, so the obvious places to look. One of the obvious places is changing public opinion about deficits. In a way, this is true. I'll show you at the end something that's suggestive of that. But public opinion about deficits is notoriously fickle and easy to manipulate. It may be that they're changing financial market reactions to deficits. Real interest rates were lower in the second period. Net interest to GDP was lower. And of course, we've all had this experience where we've learned over the last 25 years that there's more fiscal space for the U.S. than we thought there was 25 years ago. That almost by definition means we care less about debt and deficits than we did before. And then there's kind of this notion that, well, you know, things were easier back then in the good old days. There's no Great Recession or pandemic. There was actually a peace dividend from the breakup of the Soviet Union. There was the Great Moderation and entitlement spending, which has shown to be harder to reform than discretionary spending, was a smaller share of the budget. So just some graphical results here. It's very difficult to find a long time series on public attitudes toward the deficit. If anybody has one, please let me know. This is the best we could come up with from Gallup polls. And, you know, the numbers are all over the place. I'm not going to try to pull out a trend here. Real interest rates we calculated in several ways, and they were lower in the second period than in the first period, not surprisingly. Net interest hit a trough in 2004, but generally was lower over the second period than the first period. And then entitlement spending went up from less than half to almost 70% of spending. So the second category of behaviors are more political things. The budget rules that were enacted in 1990 expired in 2002. They were partially reinstated later. I personally am of the view that they are not particularly enforced. They don't impose great constraints, that they the expiration reflected a pent-up demand for looser fiscal policy. In the first Bush administration, we had tax cuts, we had discretionary spending up as a share of GDP, we had mandatory spending up as a share of GDP. That had almost never happened in earlier administrations. The second possibility is increasing partisanship, polarization, tribalism in Congress. There's a New York Times article that said that no Republican had voted for a tax increase from 1990 to 2012. The article was written in 2012, so presumably farther. But that only makes it hard to do tax increases. It makes it hard to do any kind of negotiation, because if one side won't negotiate about their thing, why would the other side negotiate about their own thing? And then the third thing that comes to mind is the increased prevalence of unified government. In the last 4 administrations, I think we've had unified government to start out with, and that tends to raise deficits. Clinton was the one exception. The increased use of reconciliation for deficit-increasing policies rather than the original purpose of deficit reduction could also play into this. I don't know. This is just a graph that shows you what you know, which is that partisanship has increased. Finally, I want to turn to the true reason this all happened, which is on January 10th, 2004, the New York Times reported Dick Cheney's statement that Reagan taught us that deficits don't matter. And that's perfect timing to explain the 20-year shift in Allen's paper. So all we needed to solve this problem is for Cheney to say publicly that deficits do matter. But obviously tongue-in-cheek, but this is a noticeable contrast from 10, 12 years earlier, where Rubenomics was pushing the Clinton administration to cut the deficit, to lower interest rates, to boost the economy. And 2 years before that, where, believe it or not, Ross Perot won 19% of the vote on a largely anti-deficit platform. So there does seem to be a change in the ether, a change in the public opinion about this, but it'd be nice to be able to pin that down in a survey. All right. So the key question is, will policymakers change their behavior? And some of the causes of behavioral change seem temporary to me. Some seem permanent. On top of that, you've got the issue that the underlying fiscal problem is different than it used to be. We didn't just come out of a recession. We didn't just come out of a war. We've got this long-term spending built in. So the paper, I think, has really helped us understand several aspects of the fiscal situation. Thank you.
Second discussant is Valerie Ramey.
Thank you. All right. Well, thank you for asking me to discuss this paper. I learned a lot from it. So initially I said, what new can be said about the dismal fiscal situation? But leave it to Alan and Danny. They really looked at this and rigorously confirmed what we suspected, which is the situation is bad. Nobody is doing anything about it, even though they used to. All right. So they not only do look at different kinds of fiscal rules, but they look at them with full certainty, but then show what happens once you get shocks like pandemics and those sorts of things. So they did such a good job on their presentation, and also Bill summarized some of it. I'm going to skip my first 2 slides. I'm going to talk about 2 main things. One is thinking about fiscal feedback, and the second thing is going to be a case study of how the U.S. reduced the debt to GDP ratio by 30% in the 3 years after World War II, if I get to that. Okay. So let's just think a little bit of background. This is, the kinds of things that this actually follows to some extent the Blanchard, Leandro, and Zettelmeyer paper. So let's think about debt dynamics. So B is the debt to GDP ratio. S is the primary surplus to GDP. R is, let's call it the real interest rate. I'll do things in real terms. And G is the GDP growth rate. All right. So the change in the debt is going to be equal to what they call the excess interest rate term, R minus G over 1 plus G, times the lag debt minus the surplus. All right, so that's basically an identity. Now, Henning Bond, back in 1998, when nobody was really caring about fiscal stuff, came up with what's the foundation of what we still talk about today, which is he estimated over a long period of time that there did seem to be a feedback rule, that primary surpluses relative to GDP were equal to a constant, which is related to the initial surplus. And then there was a feedback from the lag debt to GDP ratio. So that D parameter is really important. So he estimated something that wasn't zero. And then he says, but you can have cyclical things like responses to the output gap. But the key was that cyclical thing had to have mean zero. All right. So remember that. Remember how their effects is a ratchet upward, always positive shocks. Now, if you plug that feedback into the debt dynamic equation, then you get a particular path of debt dynamics that allows for this feedback. And the interesting thing, and of course this is what Olivier Blanchard was emphasizing, is that what matters is that term, the excess interest rate term, the R minus G term, minus D, where D again is that parameter on the feedback rule. And it turns out, if you have complete certainty, if that D is greater, so the strength of the feedback is greater than the R minus G term, then the debt ratio will never explode. Now, this doesn't mean it won't go above 250%, it just means it won't explode. Now, contrast that to what Auerbach and Yagan talk about. So the bond rule says you've got to respond to the lag debt to GDP ratio. This is the correct feedback if one cares about the debt path. Going back to optimal control again, you've got to have the state variable in there. Now, the Auerbach and Yagan baseline rule has primary surpluses respond to the CBO's forecast of the primary surplus GDP ratio over the next 5 years. There's no debt feedback in their baseline. And I kept saying, why did they exclude this? These are smart guys. And then I realized it's not really fair to call it the Auerbach-Yagan rule. It's what they estimated in the data. Even in the earlier period, you get a zero on debt. And so then I said, aha, that's why they're actually simulating something that's more realistic. In neither period did it respond to the debt GDP ratio. Okay, now contrast this again. Let's go back to that bond rule. It actually turns out that even if D is equal to zero, there's no feedback from debt. It's okay in terms of explosions of debt GDP as long as the real interest rate is less than G, all right? And that was the whole idea of the R minus G. But this isn't the case if we account for at least two other realistic features. There's probably more ways to look at this. One is, suppose there are political or economic constraints on the primary surplus, or suppose that there's shocks, all right? So I'm going to talk about these constraints first, and then later I'll talk about shocks in terms of their stochastic simulation. So as Blanchard and I'll talk about, if you have some upper limit on how much of a primary surplus you can run for political reasons, for fiscal reasons, then suppose that's S bar. Then the maximum sustainable fiscal debt is given by this equation, the S bar times actually the inverse of that excess interest rate ratio. So that means suppose that the maximum that you can politically run for the surplus is 1.5%. And suppose that R minus G is 1.5%, so R is a little above G in this example, then the maximum sustainable debt is 100%, all right? So this helps us think about it with constraints. Now, before talking about the uncertainty, let me just talk about their models and simulations. So first, they go through these different rules and combinations of those rules. They first look at it under certainty. You saw a lot of those graphs. But then they start looking at what happens when you look at shocks and allow for shocks to various elements of the rule. And then you really get the probability of unsustainable paths using the post-2003 estimated rule to be unacceptably high. Now, there are two things that they omit in their simulation. I mean, so their simulation's nice, but I'm just giving you an idea of how things could be even more pessimistic, all right? So first of all, I mean, nobody would expect me to talk without talking about multipliers. They actually assume that multipliers on both spending and taxes are zero, all right? So there's debate about the magnitude of them, but most people don't think they're zero. And evidence suggests that on average, fiscal consolidations are painful, right? They reduce GDP. This is why, the Congress doesn't want to do fiscal consolidations. The second thing is that their stochastic processes don't allow for covariances, and let me explain why that's important. It has to do with that shock that's trying to, pick up that ratchet effect, but then I'm going to talk about another kind of shock. So suppose we have a model in which news arrives of a secular decline in GDP growth. So that G in that excess interest rate term, say, falls to a lower level. So we have a growth slowdown. We've experienced those before. Likely consequences, if you've ever worked through one of these models where you get news of a growth slowdown, persistent or permanent, you're going to get a recession in the short run typically because how consumption and investment will respond. That means you're decreasing GDP in the denominator, the debt GDP ratio. But of course, government, maybe because somebody says, oh no, secular stagnation, we need to stimulate the economy, starts doing a debt finance stimulus, and that increases the debt. So both the denominator's going down and the numerator's going up. Now, although the stimulus is temporary, hopefully, the debt GDP ratio doesn't decrease because that lower G raises the excess interest term. In this scenario, the shocks to Auerbach-Reagan's debt and excess interest rate equations are correlated. That means that the risk of explosive debt paths is even greater than what their simulations show. And an example is if you look at that nice graph they have of the excess interest rate, you'll see that R was way above G during the Great Depression around that time. And geez, there it is right during the Great Depression that you get this bad excess interest outcome. Well, was that bad luck or was it correlated shocks? Well, a standard dynamic model will tell you that it wasn't bad luck, it was correlated shocks. Of course, the problem is that when you get those shocks, raising taxes or lowering spending in these bad states is particularly painful. That's why you want to try to do these fiscal consolidations when the economy is doing well. Let me not do this. So, actually, I do have that. Oh, the presence of shocks is also really important for this feedback, whether it's deficits or debts, okay? So the rule implies that the government, if you just use the deficit rule that they estimate from the data, they ignore the effects of past shocks. Pandemic, yeah, sure, we raised the debt, but we're not going to pay attention to that. Great global financial crisis, we're not going to pay attention to that. They just care about what's happening now. So you just keep getting these ratchet up effects. And in fact, their simulations show there's no parameter value in the deficit feedback rule that guarantees that the debt GDP ratio remains under, I think it was 200% with 95% probability. All right, I am pessimistic about fiscal reaction functions going forward. Let me just say briefly, for this part, before a lot of the spending was due to things like military buildups or infrastructure projects. Those had a life cycle, all right? Even the Cold War. In contrast, entitlements are forecasted to just keep growing because of aging. Also, Congress, when they do things with entitlements, they almost always make them more generous. They rarely, I couldn't even find a case where they significantly made them less generous. All right. So going forward, I see even less feedback simply because of the type of spending. So let's look at one of the cases where debt to GDP was as high as now, which was, of course, after the end of World War II. So this shows a graph of revenues in the blue line, or sorry, outlays in the blue line, revenues on the green line. And the lines there, the first one is the end of World War II in mid-1945, and the second line is the start of the Korean War, okay, because there was a war just 5 years later. And the Korean War looks small here, but that's only because I have World War II on the axis. If you do post-World War II period, Korea looks huge relative to Vietnam and anything else. All right. So let's look at 1940 and 1950. Public debt goes way up and then comes down. This is debt to GDP ratio. Now, part of it was the primary surplus. They managed to start generating a primary surplus soon after the end of the war. But then look at the third graph. That's the GDP deflator. They had all those price controls on during World War II. They lifted them, and the price level shot up 30%, almost 30% in 3 years. So I actually did a decomposition. What exactly was reducing that debt to GDP ratio? Turns out the surplus simply compensated for the decline in GDP when you're coming down from World War II. So those cancel out. So the entire fall was due to the inflation tax. So I keep forecasting higher inflation in the future, knowing these incentives. Tips aren't, but I think that could be a big issue. So anyway, this is a really neat paper. So I've talked about ways basically that it could be extended, not flaws in the paper, but ways that it could be extended. And I think what they've done here is really important. And all I can say is gone are the days of leaders and candidates who cared about the deficit. And I have Truman there because he financed the Korean War with taxes.
Thank you so much. I'm actually going to exercise my prerogative and make the first comment myself this time. I really liked it how Bill brought in the historical perspective for the United States with the figure all the way back to the founding of the Republic. And it looks like a very well-behaved series, as Bill described. Things go up really fast during wars and then come down really fast after wars. Now, I think another historical example is also instructive, which is the UK. If you look at the same figure for the UK, which you can do back to about 1700 actually, it looks way, way less benign. It's a really, really ill-behaved series. It keeps going up and up and up and up for 100 years, from 1700 to 1815. And it's just slowly, and there's really nothing in between the wars that's going down, and it just looks like it's going on forever. And then for 100 years, it just goes down and down and down and down and down. And that's under a gold standard, no inflation. So, I'm scared about this too, but, short samples can be kind of deceiving, I think, in this context. Jason.
So 4 comments, not counting that this is an incredibly terrific and exciting paper. The first one is, as much as we like to look down on the political system, we're the people who were even worried about the debt when it was 35% of GDP, when it was 50% of GDP, when it was 70% of GDP. Now it's 100% of GDP. The 10-year is less than 4%. The economy is growing at 3%. Maybe Trump and Biden prove deficits don't matter. Second point is, it is possible that the fiscal system's reaction function is to something like real debt service. And now you might ask, why would they have a reaction function to something Larry and I proposed a few years ago? Part of why we proposed it was eyeball empiricism that looked at that series in the past, not systematically like you did, so I'd love to see it systematically. And it looked like when that went up, people did a lot. And when that was low, people did very little. And maybe that's what they were reacting to. The fact that your sample doesn't work well since 2004, we've been at the zero lower bound for 50% of the time since 2004. The consequences of deficits are very different at the zero lower bound, and potentially the need for them and the need to remedy deficient demand is very different. And so maybe that reaction function should be different. Third point is, if you're rational and time consistent and you two are in charge for the rest of time, you could obviously come up with better rules than the one you had. You could avoid the 5% tail risk with things that were more nonlinear and do even less now. But my final point, which goes a little bit against the spirit of all my others, is that policymakers, notwithstanding what I began with, probably aren't fully rational and fully time consistent, not up to the standards of the two of you. And in that respect, I was actually surprised that you came down for a rule that would have much less deficit reduction over the next decade than I would suggest. I would be aiming for something like primary balance, debt declining as a share of GDP. Yours works if you stick to it forever, but if at every sort of decade you reset and expect someone else to do it, it won't, and it loses the type of anchor that either primary balance or declining debt would give you.
Doug?
Thank you. A really interesting paper and discussions. My comment builds a bit on some of what Jason said. As I think back to the 80s and 90s and what worried people about budget deficits and I think caused them to support people like Ross Perot, it was a view that deficits raise interest rates and deficits can raise inflation. And so we've had over the last few decades consistently low interest rates and consistently low inflation. So the triggers that got people worked up and then caused them to lean on policymakers to take actions really haven't been there. Now, it happens the last few years, we've had big deficits, we've had some increase now in interest rates, we've had some higher inflation. I'm not saying those are all totally causally related, but I think that's an example of the sort of phenomena that if it recurs in the future might be the thing that would cause policymakers to cause the public to react and then cause policymakers to react as well. Thank you.
Neil and then Debbie.
So this is both, I guess, a question and a comment. Just to understand a little bit more, what is your assumption about the response of interest rates to higher debt to GDP? The CBO makes a particularly stark assumption that dominates their out-year projections, where every percentage point of debt to GDP raises the real interest rate by 3 to 4 basis points. There's not a lot of great empirical evidence on this. You go to the Laubach paper, which is one of the better empirical work in this area, and those estimates are unstable. They actually, if you extend the sample, the coefficient becomes insignificant. And in structural models, structural OLG models, you can get substantially smaller effects of increases in the debt to GDP ratio. So that seems to be quite important for thinking about debt sustainability, and be great to hear more.
Two comments. One reason that hasn't come up, which I think makes the growing debt even scarier, is that it's happening all over the world. And we don't know how triggers in other countries could spill over to us and vice versa. But in any case, I thought the analysis was fascinating and wonder if you or maybe your students could be induced to look at the time series in other countries. John alluded to the UK, but I mean, it would be interesting to see if in places where there have been these growing pressures, maybe even more severely than in the United States, how those countries responded to it. And then secondly, just to make a quick comment on the interest rate, you know, it won't always be a risk-free rate. So when we think about that correlation, when debt gets very high, at some point there's a risk premium, and that can really accelerate the pressures. And I wonder whether you've considered feeding that into your model.
Henry Aaron.
First, a point of correction for Valerie. If you're looking for a cut in entitlements, go back to 1983, when Social Security was significantly cut to restore balance, along with some tax increases, but it was mostly a cut in benefits. I have to say, I find this session and the body of work peculiar. I am reminded of Orthodox Jews who do numerology on the Talmud in order to predict current events. Nobody in the course of this session has uttered the word tax, not once. And yet, that is a major actor in the story. And what is behind that story is a set of political commitments and actions. We are economists. We are going at it with the tools we have. Give a kid a hammer, everything looks like a nail. But the roots of this problem are not in the numerology. It's in the politics. I'm not suggesting that the forces that are being discussed here are irrelevant in shaping the politics. But it seems to me that an examination of that process is the key to understanding where we are and where we are likely to evolve. And that the numerology here really doesn't provide us a lot of guidance. I realize this is out of step probably with everybody else in the room, but I think that comment needed to be made.
Ethan.
My comment may be a little bit in step with that. So I view this type of question in three layers. One is the type of empirical reaction functions and debt sustainability exercises that you've conducted, and I think they're extremely useful and also very well executed. I would say the next layer that I would think of is fiscal rules that try to enforce the type of behavior that we would like to see. Now, I'm actually very skeptical of that second layer because when we look around the world, there are many countries with fiscal rules, but there's almost no correlation and no evidence that those fiscal rules actually bring down deficits, let alone lead and may even have some other negative side effects. And so when we ask why are fiscal rules ineffective? That's because those same legislators that set the fiscal rules are the legislators that can change them, and are the same legislators that want to run deficits can change the fiscal rules at a whim. Which brings me to the third layer: what are the fiscal institutions that enforce those fiscal rules? And I think where fiscal rules do work. Actually, it doesn't matter if it's a formal or an informal rule, is where there's an institutional structure that enforces fiscal discipline. So insofar as there's been a change in the past 20 years, and Valerie put a little bit of skepticism on there actually having something change, but if there has been something that changed, I would want to hear more about what is it that's different this time than in the past. What has been the degradation of the fiscal institutions, the politics? Is it entitlement? So I think this synthesizes a lot of the other comments that has changed in the past 20 years relative to the previous periods.
Jonathan.
Yes, so this goes a little bit to Bill's unanswered question and Doug's trigger. You never know what's in term premium, but it was surprising last November at the Treasury's refunding announcement when the Treasury changed the composition of their planned issuance, and the 10-year yield moved quite abruptly, and the ACM term premium model fell 20 basis points on that announcement, which was a very surprising degree of sensitivity of financial markets to the supply of duration. So, that's something that we haven't seen in financial markets, to Jason's point, in a few decades, but this may be something that we need to think about going forward.
Maury?
Yeah, just three points. The first one is actually related to the last comment, which is, to what extent do you think about the maturity structure of debt? Does that respond systematically to deficits or the level of debt? Of course, this is going to affect the way that various shocks feed through to the deficit and debt levels, and could be potentially important. A second point relates to the intertemporal budget constraint in a setting where you're not following a bone type rule. We talk about debt levels reaching 250%, 300%, But ultimately, it's the intertemporal budget constraint that has to be satisfied. And if markets think it's not being satisfied, then interest rates will adjust endogenously. And the kind of jumps you have could be thought of as confidence crises, but these potentially would be functions of what the markets see going on in Congress with debt levels. Finally, John Steinson's point about the UK and the gold standard put me in mind of a seminar we had at Berkeley a couple of weeks ago, Bank of England economist named Oliver Bush. And what he's done, I don't think the work is published yet, but he did a kind of Romer exercise with statements of the Chancellor of the Exchequer, the budget speeches in the UK Parliament. And he finds that in the gold standard period, when, as John pointed out, these debt levels came down, the chancellors would explicitly mention that policy was responding to the high level of debt. And I think that's a key component. They're basically following a bone rule, and that ceases later in the 20th century.
Joe.
Yes, thank you. So as you can imagine, we have pension funds are part of our client base, and they're kind of interested in this question. And so they ask me for a prediction about what is going to change or what happens. And I channel my inner Clubber Lane and say, prediction? And they say, yeah, well, we would like to avoid the pain. And so I would invite, and I guess the point of the paper is it used to be the case that we would have predicted pain, and that was what would get us off the, get the Congress working. And now it's probably, at least my prediction seems to, Valerie seems to agree, is that it's going to be actual pain. And so I would just invite some sort of conversation as to the extent and what type.
Wendy?
I want to talk a little bit about what I think the relationship is between inflation and deficit. So with a credible independent Fed, predicted deficits going forward shouldn't be inflationary. We should only worry perhaps about unanticipated increases in the deficit if we're going to think about inflationary effects. And so then you might think, but what about strategic inflation? And, you know, work by Bill Gale and Louise Chainer has convinced me that this is not like the World War II episode where inflation solves our problems, because our problem isn't really so much the stock of debt. Our problem is projected deficits going forward. And inflation can help us with the stock of debt, but it's going to make it much harder to finance our deficits going forward. So strategically, inflation doesn't really work. But then you might say, so which gets me to, like, then what's the risk premium that we're worried about? I mean, I don't think the risk premium is really inflation, because I don't think, at least if we're being strategic, that solves the issue. So then is it default? Well, default has the same problem. Default cuts us off from financial markets. And again, our problem isn't completely the stock of debt. The problem is, under current law, and most certainly current policy, we need to finance a whole lot of borrowing going forward. So default doesn't solve that either. So, you know, anyway, I'm not sure what that risk premium is supposed to be reflecting.
Mark.
It's a great paper. I want to give a couple suggestions for more work for you all. The one is just to, I think, say explicitly what Doug and Jason did implicitly, which is you should try this again with a interest cost feedback, maybe also interest rates and deficits. The second is when you're looking at legislative changes, it looks like you're looking at CBO's sort of legislative changes section of their biannual baselines. That includes extrapolations of one-time discretionary spending that may be messing with your numbers a bit, especially during the global war on terror period. So I'd encourage you to see if removing those changes the outcomes at all.
David.
So this is all really interesting, and I want to start by underlining the point that Bill made, and then Henry Aaron reiterated that the political science side of this is not a sideshow; it's fundamental. This being Brookings, people are usually pretty free about doing some armchair political science. I haven't heard much, so I'll do a tiny bit of my own, which is. It feels like a game of chicken, and you're not playing a game of chicken optimally if you aren't running some risk of the disastrous outcome. So if you do the thought experiment, so as you went to either Republicans or Democrats and said, things are going to be fine, we're confident of that, then whichever side it can be, say, okay, well, great, we're not going to concede on spending our taxes, as the case may be. So my incredibly simple first step model of the political side says there has to be a strictly positive chance of a disastrous outcome in the current political environment. And I think if I tried to calibrate that model, I'd end up with more than strictly positive.
Robin.
Question and a comment. Danny, question for you, I guess. When you talked about the calibration of the shock, you were talking about excluding the Great Depression and World War II. I mean, this is implicitly, I think, an assumption on the periodicity of the shocks. So how sensitive are your results to that? I sort of was listening to Valerie, and I was thinking we should include those excluded episodes, and so presumably that would increase the vulnerability of the whole exercise. The comment is that, and this goes back to Jason's point and something that Brian Sack was talking about yesterday. I mean, we have a number of bond market accidents globally that are happening that I think without central bank intervention would be resulting in substantially higher interest rates. Think about the Treasury market blow up in March 2020 at when COVID first hit. The Fed did huge interventions. Think about the ructions in periphery debt markets in June 2022 when the ECB introduced a new facility to buy periphery debt with no strings attached. Think about the LDI blow up in the United Kingdom in September and October 2022. So, I'm just saying the obvious, which is there's an obvious monetary policy angle here, and we're suppressing the interest rate signal.
Louise.
Yeah, I just want to follow up on the political economy thing, which is I think what's going on here is until the public actually cares about deficits, you're not going to do anything, because even if you're like a good government person, like I want my priorities, but I'm going to pay for them, well, that's just going to create room for the other side next time to have a big tax cut. So it's foolhardy to do it on your own. So both sides have to get to the point where they agree, where you actually think a compromise isn't just going to be where you're losing in a longer game. And I do think it's something like interest rates. It's something that gets the public there, and then the politicians will respond, but not till then.
Okay, let's hand it back to the authors.
Is there a button? Oh, yeah, it's on. We got a lot of great comments here, and we thank you for them, particularly our discussants, Bill and Valerie. It's notable that they both mentioned Ross Perot. I don't know what to take from that. Just on the macroeconomic cyclical fluctuations, which we suppressed in the analysis, and which Valerie pointed out. I mean, just a couple of points. First of all, in the estimates that we did of the deficit feedback rules, there is a GDP cap term, and with the pictures that excuse me, that Danny showed had that taken out to produce residuals. So we certainly recognize that the deficit reduction, even if necessary, is unlikely to happen and shouldn't necessarily happen when the economy is weak. In terms of how that omission affects our model, I mean, we're really thinking about a longer-term model, and I guess you would say that we're sort of assuming that these fluctuations and the deficit responses to normal fluctuations, not these big debt shocks, are sort of canceling out and therefore not really affecting the long-run trajectory very much. Neil asked a point about how responsive are interest rates. I think that came up again. How responsive are interest rates to the debt in our simulations? I think I mentioned sort of very quickly in passing that we're sort of trying to mirror what CBO is projecting over the next 30 years. Specifically, what we end up with is a sensitivity of effectively 0.8 basis points per percent change in the debt to GDP ratio. That is smaller than CBO's current approach, which I believe is 2 basis points per increase of percent in the debt to GDP ratio. And I've learned that really is, as we suspected, reflects the fact that there's more in their model affecting interest rates than the debt to GDP ratio, and things like demographic change are pushing interest rates down. And so the increases that we're measuring relative, of interest rates relative to increases in the debt to GDP ratio are actually understating what's in the CBO model for that partial relationship. So to the extent that you think that CBO's estimate of 2, coefficient of 2, or their previous estimate that was higher than that is a bit too high, then we're not incorporating that full effect, and we're not even sure, whether we should do. Maybe perhaps we've been thinking maybe we should do more than we're actually doing. On a lot of the politics and what's changed, I certainly agree with Louise's point. That if the other side does it, she worked in the Clinton administration and remembers all those surpluses that they handed over to George W. Bush for his tax cut. Probably has that in mind. But that, in a sense, doesn't answer why things have changed, because it was in 1990 that the first George Bush, in conjunction with the Democratic Congress, did engage in substantial budget cuts. So something changed. Obviously, you need two parties, both parties to play, but we don't know why they stopped. It could be polarization. It could be that with interest, as Bill suggested, with interest rates falling, maybe people are less convinced that deficits matter than they used to be. And it's really hard to say. And I agree with you, and I agree with Hank, and with everybody else who highlighted the politics. I guess to Hank, I would ask the following thought question. Okay, in 1983 we had entitlement reform. We're going to need something in the next decade of a similar nature to deal with Social Security running out of money. How much would you want to wager that we don't engage in anything that increases Social Security taxes, raises the retirement age, or cuts Social Security benefits, but instead uses general revenue funding? And I think, to me, that illustrates that there's been a change in the environment. And yeah, we were able to do it in 1983, and we were able to do it in 1990, but doesn't provide very much comfort for the current situation. I think I'll turn it over to Danny for the remaining comments.
Thanks, Alan, and thank you, everyone, for your comments. First, to Robin, yes, the estimates are sensitive to the number of the sudden deficit disasters, and it's art more than science. It's more art than science of what your average number per century is. To tie a few comments from Jason and Neil and others, we deal with two types of uncertainty in the paper. Those deficit disasters, and then what are your shocks to this AR1 process for the excess interest rate? There's other uncertainties that are very hard to model. What is the central tendency of the excess interest rate over the next century, even holding constant the debt to GDP ratio? There could be unexpected changes in global demographics that move it up or down. That's very challenging to model. What is the reaction function of what's the feedback of the debt ratio into the excess interest rate? Is it linear? Is it nonlinear? The estimates are all over the map. In one of our regressions, the sign is wrong on the debt to GDP ratio when you regress the excess interest rate on the debt to GDP ratio in just a simple regression. So this links into what Jason was saying. You economists told us not to breach debt to GDP of X and Y and Z, and look, interest rates have come down. So let's just wait and see. And part of what we wanted to do here was actually what would a wait and see strategy look like under certain plausible shocks. And actually, that type of, in talking to the political participants, one hears that. So we've heard a version of that in the political strategy. Why cut the deficit now if you're just going to blow it up in the next term when the party changes hands? Another version of that is an economic uncertainty version, which is why should I raise taxes now or cut Medicaid now for some uncertain benefit of from the fiscal envelope over the next 100 years? And to bring this back home, Peter Orszag, and I think in Brookings a year ago, OMB director under President Obama, I believe known as not a deficit dove, said, hey, you know what? Climate change is a risk that we can't just in 30 years decide to start taking seriously. But in 30 years, if there's a fiscal crisis, we actually can do a fiscal consolidation and then fix it immediately. So if forced to choose, I will trade one risk for the other. And I do think that the political constraints, the political science is obviously first order, and I think it's also useful to follow the, what uncertainties are the participants trying to take seriously.
Okay, let's break and start up again at 10 a.m.